Q2 revenue was $2.7 billion. That's up 31%, and free cash flow was $422 million. So, if you're keeping count, that's 11 consecutive quarters of positive free cash flow and 8 consecutive quarters of double-digit free cash flow margin. And I think we're delivering consistent, durable growth here.
That is extraordinary. Now, I know there were a lot of people who felt, you know what, I got to bet against Harley because the tariffs are going to crush them. I guess the tariffs, how bad did they hurt you?
Yes, so to be clear, we are still growing really well across all our regions. We are monitoring, obviously, how things are going, but so far we are seeing no slowdown from the tariffs, and that includes up until early August, where we are today. So the merchants on Shopify, the millions of stores on Shopify are doing very, very well. They're finding new areas to sell. They're taking more of our services. Our expansion is well beyond just North America. We're obviously international growth is incredible. We're moving well beyond e-commerce into things like point of sale as well. And generally, Shopify is performing incredibly well.
Well, let's go back to the nature of your company. If you're starting a company, any company you have e-commerce, there's tremendous headwinds just to be able to get it started. If you go to your site, it's still clear this is the way to be able to get on. You onboard very quickly, and you start getting your checks very quickly when you start selling. What is the secret sauce behind your amazing numbers?
Yeah, first of all, in terms of small businesses and large businesses, the key is to make sure that merchants on Shopify can sell across every surface area. If you go back years ago and you saw what we were doing when we began to see that social commerce might be something that was growing, we immediately integrated with all the major social platforms, whether it's Instagram or TikTok or Snap. And then as we saw that things were happening in culture and music, we began to integrate with Spotify, so you can sell products directly on Spotify. And obviously yesterday we announced our agentic commerce products, which means that, with all these AI companies, we're able to embed commerce, make it really easy for them to embed the entire Shopify catalog directly in those agents. And now consumers can spend their time in those agents finding great products that they love. And the unfair advantage we have is that consumers' favorite brands, favorite products, they're all on Shopify.
Harley, it's interesting to hear you say that the tariff impact has been muted so far. What are your expectations about the impact going forward?
Look, we can't anticipate every change for any administration. What we try to do, and we've been doing this now for 2 decades, is to better prepare our merchants for whatever is coming. I mean, Carl, I was on your show literally the day after the pandemic hit, and we talked about how we were shifting to things like curbside pickup and touchless keypads for point of sale. Our job is to be the retail operating system for the millions of merchants that use Shopify. And the way we do that is by future-proofing their businesses. So whether it's things like tariff calculations, or it's things like moving online or offline during the pandemic, what we try to do is make sure that Shopify merchants are simply better prepared for anyone else. And what it's done is it's built this incredible trust battery with the millions of businesses that use Shopify. And the end result is that not only are small businesses coming to us, but the largest companies on the planet are also migrating to Shopify. And that's why you're seeing these incredible results.
Right. Now, I understand that, and I appreciate the nimbleness of modern corporates, but comparing the tariffs to the pandemic might not be so comforting to some.
Look, we've been hearing about the tariffs and even the de minimis changes since early March, and we just haven't seen anything yet. So we'll continue to monitor it, but so far we've seen nothing that changes our business or the business of our merchants. I mean, on the call today we mentioned that we are seeing some increase of pricing by some of our merchants. We'll continue to monitor that, but beyond that, we haven't seen any slowdown.
Harley, a broader question from me. I'm curious as to how you're using AI at the company itself and what your expectations are in terms of the efficiencies perhaps that you can introduce both for your customers but also for Shopify itself.
Yeah, we've been, I think a lot of companies will benefit from AI, but I think Shopify specifically has an opportunity to leverage AI both internally and for our merchants. From the merchant perspective, I mean, we talked about small businesses earlier. We built Shopify Magic, which effectively embeds AI across the entire product of Shopify. So whether it's simple tasks like product descriptions or creating better product photography, or it's figuring out, what orders or what products and what SKUs are selling better and where to place marketing dollars, we think we can actually create these superpowers. We call it sidekick because every merchant needs a sidekick that allow them to grow business at a much faster clip. But internally, we're leveraging AI in 2 ways specifically. One is on making our product team and our engineering team a lot more efficient, but also from a support perspective, making sure that when you call Shopify, when you want to talk to someone, that the high quality conversations are done with a human, but those low quality conversations where you need something like configuring your domain, AI does a really good job of that. So we've been an AI native company for a long time. The way we think about it is being AI reflexive. And that's not just necessarily in the engineering team or support, that's across the entire company.
Now, Harley, I've been trying to figure out for our viewers the distinguishing in e-commerce. And look, correct me if I'm wrong, but I feel Amazon is kind of like stuff you need, household staples. You guys are stuff you want, favorite brands, retailers. Maybe that's also a secret.
Yeah, Amazon's a great partner of ours. We've been working with them for a long time. In fact, their daily deal site, Woot, just migrated to Shopify, so it's now being powered by Shopify. We think Amazon's an incredible company, a great partner of ours. But Amazon is really the place where you go for the things that you need, household staples, for example. But for the stuff that you want, that you love, the brands and the products that are deeply personal to consumers, those are on Shopify. Whether it's Mattel or it's Viore or it's Alo Yoga or it's Canada Goose or some of the others I mentioned, those brands are the ones on Shopify. And what we're doing is creating this retail operating system so that whatever surface area is where consumers are spending their time, again, online, offline, or places like agents now, they are able to get in front of the consumer. And I think that's creating this incredible flywheel effect that more businesses are coming to Shopify at a higher clip.
Excellent, Harley. I do want to point out that when the stock was at 79.80, Harley came on. This was a big drop and said, listen, I don't care. Let me tell you why we're great. It was a very telling moment, and you made 70 points since he came on. Harley Finkelstein is the president of Shopify. Thank you, Harley.
Thank you. Crushing the NDX today. Meantime, Dow's gone negative as Disney and Amgen weighing on the index. Disney's down 4%. We'll be right back. Jim, it was a packed hour. What's on tonight?
Well, had I had a chance to do just a stop trading, I would have mentioned Astera Labs, ALAB, up 43. A lot of that is because of the NVIDIA deal that they signed in May, but I don't have any time to talk about that. I have Planet Fitness on. Their numbers are just incredible. And then Jason Robbins, DraftKings, coming into football season, coming in hot. As opposed to, I know I came in cool. I'm sorry. I didn't even get to mention Jurist and Ned and Jay Shrishayu, which is a number that even competitors are saying is incredible. And Alex Karp, congratulations again for getting the stock up. What a guy.
What a guy.
What a sweetheart.
Jim,
That
we'll,
motor's
tomorrow,
not used
man.
by anyone in the world. Remember, he also has the pistol competition he does.
we'll see you tonight, Jim. Mad Money, 6 p.m. Eastern Time. When we come back, an exclusive with Lucid's interim CEO on the challenges facing the EV maker when we come back.
Is all about.
Good Wednesday morning. Welcome to Squawk on the Street. I'm Carl Quintanilla with Leslie Pickard, David Faber, live at Post 9 of the New York Stock Exchange. Sarah has the morning off. Markets holding in there amid a wave of important results from corporate earnings. McDonald's, Uber, AMD, Disney, Shopify, 10-year pretty steady at 422. Coming up on today's show, we'll talk to the CEO of Lucid, fresh off earnings, get some insights into the EV market as that stock does pull back a bit on a miss and softer guidance. Plus a lot more on today's blue chip earnings, including McDonald's and Disney, which, as you may know, just inked a major deal with the NFL.
But first, we're 30 minutes into the trading session. Here are three big movers we're watching this morning. Apple on the move after the White House said the company will invest another $100 billion in the U.S., focused on beefing up domestic manufacturing. That's on top of the $500 billion it pledged back in February. Those shares up 3.4% right now. Meantime, AMD under pressure after missing earnings estimates. CEO Lisa Su joined last hour to discuss the numbers and their shift toward manufacturing here in the U.S. Take a listen.
We're very supportive of manufacturing in the United States. I think it's good for us to have resiliency across the supply chain. We have a very strong supply chain. We continue to make sure that we're in active dialogue with the administration as we're going through this. But, clearly, U.S. manufacturing is a good thing, but we also have to recognize semiconductors require a global supply chain.
And sticking with chips, Supermicro also in the red, plummeting this morning after weak fourth quarter results and soft guidance. Those shares down more than 18% right now. Let's get to Christina Partsenevelos with more on Supermicro. Christina.
Thanks, Leslie. Well, the AI server assembler really is caught in the classic growth trap. They're trying to scale production to meet AI server demand, but they're just burning through cash and sacrificing margins in the process. Supermicro CEO Charles Liang admitted on the earnings call they lacked working capital to expand as quickly as needed, which is why they had to issue a $2.3 billion convertible bond offering just in June. The margins really tell this story and why you're seeing the stock down so much. They collapsed from 18% at the end of 2022 to under just 10% right now. That's what happens, though, when you're assembling expensive AI components, but you have to compete primarily on price against big players like Dell and HP Enterprise. Mizuho points to customer concentration as a risk. There's about 4 customers who contribute over 50% of revenues. One of them is just massive. The bull case, though, hinges on their technical advantages. They're typically first to market with new AI server configurations, and their liquid cooling technology becomes more valuable as NVIDIA rolls out more powerful chips because you got to cool them down. But they need to prove they can translate technical leadership into sustainable profitability and not always have to wait on NVIDIA to deliver their next set of chips. That was a major complaint for this quarter as well. Supermicro, though, is riding one of the biggest infrastructure buildouts in tech history, but investors just are learning that being a picks and shovels play doesn't guarantee a gold rush profit when everyone else like Dell and HP are selling shovels too. Guys?
Christina, I wonder what you made of the interview with Lisa Su over at AMD. They're still a little reticent to put any numbers on these China shipments if and when they begin.
Yes, that was a major concern for the upcoming quarter. But if I were to point out, NVIDIA spoke to analysts after the United States said they were going to be putting these export controls and allowing those chips to be sent. And NVIDIA said that you wouldn't actually see it until Q3, if at best Q4. Why? Because these licenses take a long time to get in place. There's paperwork. And so for AMD's case, just especially in Lisa Su's interview today, as well as on the earnings call yesterday, she was very unsure as to where they stood with those licenses. I'm paraphrasing. But that was the takeaway from a lot of Wall Street, and which is why you can't really price it in. But we knew this. So the negative reaction to the stock shouldn't be contingent on the AMD chips going to China. There's the drivers, the GPU they said they're going to be ramping into this year and to next year. They have next iterations. She called out NVIDIA specifically, saying that their chips compare to NVIDIA's Blackwell 200 when it comes to inferencing. So I don't know if we really need to pay as much attention to China for this downward trend on the stock right now.
Right. Christina, thanks. Talk soon. Christina Partsenevelos, busy day for semis. Let's get to McDonald's this morning. They did serve up an earnings beat. EPS and revenue came in ahead of expectations. Global comps up 3.8. Let's bring in Evercore ISI analyst David Palmer, has a buy and a 350 target on the stock. David, good to see you. Comps were a bright spot, and yet the commentary was, I guess, qualitatively a little cautious. What's your take on it?
It was actually a really good earnings call. The Q&A really focused on the fact that they need to do more on value for that 50% of their business in the U.S. that is not really tapping into the digital value or their existing kind of $5-ish meals that they have. In other words, the core menu, the premium core, is those combo meals are many times over $10, and they're going to get after that. That was a very bullish comment. It certainly is going to be one that gets on everybody's mind who deals with not only McDonald's stock, but other stocks in the space, because McDonald's is really coming for the value perception that they want.
Right. We heard from Chipotle not long ago. We mentioned Dine Brands with Kramer this morning, down 8% today. Is all of this folding into a tapestry about at least the lower income cohort?
Yep. Yeah. And not only that, but you gotta win with all consumers. Right now, it looks like there's a consumer that's going to fast casual, albeit that's been slowing within the fast casual space. You're seeing remarkably strong results in casual dining. Some of those, like Chili's, have poked fun at McDonald's and the fact that their burger prices are and their combo meals can be more than the $10.99 3 for Me, which features a burger at Chili's. So McDonald's needs to firm it up on the premium core as well, and they're on the case. But also the power of national advertising in value is very is clear. The $2.99 snack wrap really has been working. They introduced that on July 10, and their comps have been up mid-single digit-ish since that time. They've locked into $2.99 for the rest of the year. So between that and some of the other marketing they have coming up in the second half, people are getting more and more excited in that system for the U.S., which is the key catalyst that they need.
How much of it is the absolute price point versus the perception of value? I ask because if you look at kind of the landscape for fast casual right now, you've got McDonald's seeing this pretty sizable turnaround here in the U.S., but Chipotle on the other side, maybe Pizza Hut on the other side. So how would you kind of characterize those companies that are standing out in this environment?
You know, you mentioned some players like Chipotle there that they don't do advertised price points, and that would be inconsistent with the brand. So they just have to have inherent value, kind of like a Texas Roadhouse, and they have to play by their brand rules. They can do some things on their app to get those, maybe a lapsed user with a freebie here or there, but they're not going to be doing what McDonald's can do, which is a national price-pointed value program, and that can really make up for a lot of ills for McDonald's in a hurry. McDonald's overpriced during COVID. They way outpriced wages during that time period. Food costs are pretty low as a percent of sales. They had to do a lot of that to make up for labor, but they overdid it. But they can really just instantly solve that with a national price-pointed advertising, and it leverages that huge advertising scale these guys have, in addition to the digital tools. So McDonald's has a clear thing that they have to do, and they're going to probably get it done here in the second half.
So, David, given the recent price action on Shack, on Chipotle, on Yum, is QSR still where it's at?
Well, you know, there's different types of stocks. You know, they're in a world of inflation and a weakening dollar. Some of those global franchise names, if they can get their act together in the U.S., and as the company was saying on their on this earnings call, McDonald's, you have to be right on all areas and innovation and marketing news as well as value. The ones that have been doing the best on that are Yum Brands. McDonald's is going to be improving. QSR just needs to just show that it can survive with McDonald's and coexist with them. So far, they're doing quite well, even in July. So we like QSR, McDonald's. In terms of Chipotle and a name like that, you're probably going to look to 26 for the best performance there, because their comparisons start to really ease, and they have a lot of tools that they're going to be deploying by then. But you're probably going to have to be more patient with the fast casual zone for re-acceleration.
Right. I should have been more plain. I was asking about the category QSR, not the ticker, but I run into that every now and then. Finally, do you anticipate any relief on at least beef prices in the next 12 months?
Right now you're seeing a remarkable amount of inflation, and it's bifurcated among steak versus hamburger. Hamburger is some of the worst, and McDonald's talked about they have 70% of their company stores in Europe, and their inflation for beef in Europe was a remarkable 20%. That reflects some of the global trade conditions as well. The hamburger is more traded overseas, but some of the high-end cuts, for example, in steak are not that bad. So the first thing we're going to find is that some of the steak players in casual dining are not going to be quite as hard as what we're seeing in hamburger land. But as far as the beef cycle, it's going to take 1 or 2 years for beef prices to be in relief. It's going to take a bit.
Right. Yeah, that goes deep into the cattle industry and what they're going to do with heifers and all that. David, appreciate it. McDonald's definitely helping out the Dow today. That's David Palmer joining us on MCD. Get a roadmap for the rest of the hour. After the break, former Goldman Sachs Asset Management Chair Jim O'Neill's with us. We'll talk about these fast-changing tariff headlines and the impact on the market, the dollar, and more.
Plus, Disney scores a deal with the NFL. We'll have details on that new agreement to boost ESPN's new coming sports package.
And we'll talk to the interim CEO of Lucid as the EV maker moves in reverse this morning on weak earnings. A big show ahead. Squawk on the Street is back after this break.
Some breaking news on trade this morning, just crossing the wires. The White House says an additional 25% tariff will now be imposed on India. That brings the total tariff to 50%. All of that due to what the White House calls Russian oil purchases on behalf of India. We'll get some more details as we get to them. But we mentioned earlier with Jim, David, that the relation between the U.S. and India has become a little more fraught, because India is in a position where they're saying you don't need to dictate to us where we buy our energy, and clearly we're trying to put some leverage on Putin and Russia.
Yeah, we have not chosen to do the same to China, of course, which is also a big buyer of Russian oil. And this goes back to Apple as well, shares of which are up almost 4%. An announcement coming later today about increased investment in the U.S., but remember, many of the iPhones for the U.S. market are made in India, and so an exemption from now a 50% tariff would seem to be something very important for Tim Cook, the company's CEO, to be able to get from the Trump administration. All right, let's continue to talk a bit about macro and tariffs and all other things. Jim O'Neill, former UK Treasury Minister, former Goldman Sachs Asset Management Chairman, joins us now. Why don't we start off on tariffs, particularly on this news in terms of India, Jim? I mean, it's a moving target on so many different countries, whether it's India or Brazil or others. What are your latest thoughts?
Well, he seems to be having a go at the two BRICS that most people would have thought were the least likely, given that India and Brazil are democracies. And, of course, I think the Modi government will be still pretty stunned, given that when Modi visited Trump earlier in the year, I think the general view in India was that they'd kind of figured a way of the buddy system working so well for them. So this is has broader connotations than just the obviously very important in itself tariff influence on price making in India. And I can't help thinking that, the flip side of Trump occasionally threatening the whole BRICS crowd about if you do anything to sort of threaten the supremacy of the dollar, you're going to get whacked. But by doing things like this, India especially, which was probably the one that was least into the sort of anti-US part of the BRICS group, might start to have a bit of a rethink about that. And I would have thought the last thing the US would have wanted is India and China trying to be a bit friendlier than they've been for a very long time. So this has got all sorts of potential big picture ramifications beyond just the very important thing of the tariffs. But separately from that, of course, what stands out is how generously on a relative basis China seems to be being treated about a growing number of issues, which in itself is not what you would have expected 6 months ago.
No, and I made that point even about Russian oil. Yeah, they're at 30% right now. Those talks continue. Now, that said, of course, things can change very quickly. And as you well know, leading to, of course, a word we've used so often and many others have, uncertainty. I mean, I am curious as to what your thoughts are about just how uncertain it can be, given we still don't know what the playing field really fully looks like, other than we do know here in the U.S. we're talking 15, 18% tariffs probably being the average.
I mean, David, all I can say, it's a bit facetious, but I'm glad I'm not the CEO or CFO of a major global multinational, because you wouldn't have a blinking clue what you're supposed to be doing the following week or possibly the following day. So I guess the most logical thing which is going on is that the inventory management of any of these kind of companies is just being a lot more closely monitored and managed by all sorts of different industries, because what else can you do? Yeah. The other thing which obviously follows from it, bringing it to domestic state of affairs in the US, we're going through this mood at the moment, as exemplified by the relatively strong bond and equity markets, that it doesn't seem to matter, and the US can just sort of sail through it, which I can't imagine that is going to be a persistent mood, because it does not make sense. I'm still sufficiently old school that the idea that the US can apply this scale of tariffs and it to have no sustained impact on real incomes or relative prices and possibly inflation in the US seems to me to be slightly in the crazy category.
You know, that's the question, because to your point, the administration would say, hey, the economy's doing just fine. We're collecting a lot in revenues, by the way, offsetting our budget deficit to some extent. So when do we start to then really feel this impact that you're saying we cannot potentially avoid?
Well, of course, this takes me directly back to last week's latest controversy, and arguably one of Trump's biggest in response to the labour market figures. I think I was joking with some of your producers when we were setting up the time to come on. I remember the days where a pretty prominent primary bond dealer nearly went bust betting on a non-farm payroll number, and a few months later, by the time it had been revised, they would have made a fortune if it would have been the same. So the idea that the current leadership of the Labour Department is fiddling the employment numbers is kind of completely crazy. But you know, if you put that in the context of the high-frequency leading indicators like the ISM survey that we had just the past couple of days, it looks to me that the US economy is slowing, and I don't really see that many indicators that are suggesting anything to the contrary. Fortunately, they're only slowing gently, and what are the causes of that are, as always, as complex as ever, but it seems to me there's some pretty obvious candidates, including all this uncertainty and the fact that companies are having to somehow try to balance between keeping profit margins up and adding on import prices that are going to end up partially, if not significantly, going to the consumer.
Do you expect that to slow even further from here, especially given just the cross currents of policy that you outlined, what's happening, you know, at the Fed, what's happening with tariffs, what's happening with the one big beautiful bill?
Yeah.
It feels like there's a lot that's kind of crossing over itself that makes the second half of the year even more uncertain.
I mean, I think the one thing that is emerged from the past week from all of this, with the caveat of, let's see the next inflation data, is the Fed is, as the markets have quickly moved towards doing, much more likely to now start cutting rates. And obviously that should help to a degree. But I think unless Trump can find a way of somehow not wanting to lash out at country X or Y whenever he sees something that he disapproves of, whether it be, you know, the treatment of a past leader in Brazil's case or whatever it might be. Switzerland, I mean, you know, the whole country of Switzerland is in complete bafflement as to why they've been whacked with so much tariff. And unless there's a bit more calmer view about all of that, I think the uncertainty, to be honest, as crazy as it sounds, might only get even more, which makes the job of policymakers, including the Fed, increasingly difficult, in my view.
Jim, going to leave it there for now, but always appreciate your insights. Thank you.
All right, thanks for having me on, guys. Good luck.
Still ahead, the CEO of digital lender Upstart joins us as that name falls this morning, down 12.7% despite solid earnings. And later, we'll talk about the big news surrounding Disney's multi-billion-dollar deal with the NFL. And McDonald's, not the only consumer-facing name on the move this morning. We'll check in with the CEO of restaurant fintech company Toast as they warn of bigger tariff impacts ahead. Don't go away.
NBC+.
Welcome back. Upstart, an AI-powered lending platform, sliding this morning down 13.5% despite beating on top and bottom lines. The company partners with banks and credit unions to provide credit products and automate loans. This is banks' look to further integrate AI into their business models. Joining us now, Upstart CEO Dave Gerard. Dave, what do you make of this stock reaction to what on the surface feels like pretty good earnings this morning?
Yeah, Leslie, look, I mean, obviously I wish it were better, but, I sleep well at night knowing that long-term the stock is going to follow the performance of the business, and we feel very good about that. Q2 was a great quarter for Upstart. We grew 102% year on year. We returned to GAAP profitability. 92% of the loans on our platform are completely automated by AI. Most of the funding, the majority of the funding on our platform comes from long-term committed partnerships with private credit. We beat guidance on the top line and on the bottom line pretty significantly. So a little hard to, understand the reaction, but that's what it is. We just try to keep going and build the business.
Yeah, I saw the 92% figure in your slide deck of the loans that are fully automated, and that's up from 73% just 3 years ago. What drives the higher automation, and why are those that are automatically reviewed more likely to be approved than the ones that are manually reviewed?
Yeah, it's it's the power of AI. A loan product is really a function of risk, and the amount that you pay on a loan and the process you go through is really about the lender de-risking that loan and trying to make it work for them. And when you bring AI into the picture, you can do a lot of that through models and much more quickly. So what you get is a process where rather than wait a day or stand in line or call somebody, walk into a bank branch, everything happens instantly and the loan is available instantly. Those convert a lot better for a lot of reasons, but the most important is it's right there when you were asking for it. If you don't have to go retrieve some documents or upload them or again, drive to the bank and sit across from a loan officer, obviously things are easier for you. So, instant approval is really good for our lending partners because it brings down the cost of lending. The AI does a better job of understanding risk, but it makes a far better product for the consumer who can just get that credit in a click.
What are the models telling you about the risk of the consumer right now? I know the demand side is there, originations up 154% in the quarter year over year, but can your borrowers repay their debts?
Yeah, the American consumer has been in what I would call an elevated risk state for quite a long time now, a couple of years. We really look at that as what is the financial health of the American consumer, and what you see is, personal savings rates are really low compared to sort of a long-term average. Default rates across every category of lending, whether that's cards, student loans, auto loans, are elevated relative to where they would have been pre-COVID, pretty significantly. But we've been underwriting to this standard for a long time. So our loans are very calibrated, and our credit is performing exceptionally well. But what's really going on is prices are very high. Credit is not as accessible as it might have been a few years ago. And but that's the nature of our business, is we have to calibrate properly to the state of the market. But we generally think there's more upside than downside because we're already sort of in a very conservative underwriting position. And there are signs, as you see from a lot of your guests, that consumers are pulling back, right? Whether it's retailers, restaurants, airlines, everybody's seeing sort of price sensitivity from the consumer. From our perspective, that's a great thing. We like to see people being more responsible with their money, earning more than they spend, and beginning to save more.
Right. What do you think the picture looks like going forward on credit demand? Do households look to take on less credit because they're nervous about their jobs, or actually do you think they're forced to because their disposable income or their real wages, for example, take a pinch?
Yeah, Carl, it's really more the latter. I think, over our long history, we almost never see what you would consider a real softening of demand of credit from the consumer. It's just always there, whether it's buying forward on something, buying the next home, paying for school, et cetera. There's just always the need there. And, we can't always serve it because the risks will change, the interest rates will change, so sometimes we can't serve all that credit. But kind of what you might consider the gross demand from credit from the consumer almost never varies. It's just, in the U.S., it's just kind of how we're built, and it's always there.
Yeah.
Dave, I'd love to just come to a broader theme. I mean, the scaling of AI in your own business, the improvements you've seen in the models. I'm just curious how you view sort of AI, broadly speaking, its usage in the enterprise. in corporate America and what your expectations are, given your own experience at Upstart and what you've really seen over in just the last, let's call it, year to 18 months?
Yeah, I mean, I've been in the technology industry for 30 plus years, so I've kind of seen it all very early in the evolution of cloud at Google. And there's really nothing anybody has seen anything like this, how quickly it's evolving. It's gotten to a point where the technology has gotten far ahead of anyone's ability to actually make products with it and make use of it. So it's a really unique situation. I think for us, AI is our product, right? So it's a little different from how companies are maybe reducing number of employees or automating things inside. We're doing some of that stuff. But for Upstart, the core for us really is we're creating a product that is entirely powered by AI, which kind of means everybody should be sort of persistently and permanently underwritten. You should be able to get the very best rate for any form of credit in a single moment. And that's kind of a different world than you know, any of us who grew up applying for a loan, whether that was a student loan or, God help us, a mortgage, you know, the process you've gone through historically. And now just imagining that to be completely gone, that credit is something that's just there for you in a moment of time when you need it, the very best possible rate. These are the kind of changes that I think we expect across so many parts of our lives because of AI. So look, we're, you know, non-shockingly, we are AI optimists at Upstart.
Yeah.
Of course.
And of course, the financial services industry spending billions on AI to automate things, just like you outlined. So we'll keep watching that space. Thank you, Dave.
Thanks, Leslie.
Let's get a CNBC News update this morning with Silvana now. Hi, Silvana.
Carl, good morning. The Kremlin called talks between U.S. envoys Steve Witkoff and Russian President Vladimir Putin useful and constructive today. So the meeting comes just 2 days before President Trump's deadline for Russia to agree to peace in Ukraine or face new sanctions. According to the Kremlin, Witkoff and Putin spoke for around 3 hours. The White House has yet to comment. Sean Diddy Combs' defense team has reached out to President Trump to request a pardon on his prostitution-related conviction. Now, that's according to NBC News. President Trump said last week in an interview on Newsmax he was approached about a pardon, but he did not announce a decision. Combs faces a maximum of 20 years in prison at his October sentencing. And Republican Senator Marsha Blackburn announced today she is entering the Tennessee governor's race in 2026. Blackburn, an ally of President Trump, will compete against Representative John Rhodes in the primary. They are running to replace term-limited GOP Governor Bill Lee. David, I'll send it back to you.
Thank you, Silvana. Well, after the break, we're going to talk a bit about Disney's earnings and that new multi-billion-dollar deal with the NFL. Of course, the company continuing to add more sports content as it gets ready to launch ESPN+. Speaking of plus, Lucid and Rivian under pressure as results from both EV names disappoint. We're going to talk to Lucid's interim CEO, find out whether he sees a bigger EV slowdown coming. We're back in a moment.
And make it count.